trend? Well, let's get the view of Jim Stening from FIG Securities with me in studio. And Jim, just how is the psychology playing out when it comes to rates, if anything, given statements by Glenn Stevens earlier this week?
Well, I think it's effectively there is no doubt now that we've bottomed in the cycle. So I think that most market participants were of that view anyway, but now I'd hazard a guess and say that all are.
We say that there's no doubt. Is that saying it's totally unequivocal?
Well, never say never.
Yeah.
Obviously things can change, but no, look, rates are set at a very accommodating level at the moment, 3%. Over the long term, rates consistently low at that level, that does have a stimulatory impact on the economy. So, realistically, the shape of the yield curve, the forward-dated bill futures contracts are all intimating higher interest rates.
Let's look at the yield curve. I've got a chart there to bring up just to sort of guide us in our discussions on that. That's the longer dated.
Yeah, this is an interesting development. I mean, longer dated bond yields have basically bottomed in the December quarter of last year, so we've actually been in an uptrend for a very long time. So, when you're thinking about fixing long-term borrowing rates, arguably the horse has already bolted. That's the yield curve there. You can see that longer-term rates are very much higher than shorter-term rates. Basically, you can do your break-even analysis as to what that means for where the implied cash rate is for the Reserve Bank over the next couple of years.
Is that a figure that they can live with, or where do you see that trend heading?
Well, I think what we're going to see with the yield curve is we're going to see longer-term rates move much higher again. Now, there are some factors that are playing out at the moment. There's the supply factor, but also actual increases in monetary policy. So that's going to mean higher long-term rates.
So it's inevitable that once we start and enter the easing, we see everything moving in that direction.
Enter the tightening. Well, it's interesting. I mean, longer duration bonds are counter-cyclical, if you like. It's counterintuitive because effectively what a tightening in monetary policy does, that will serve to slow the economy. So arguably longer-term rates can then stabilise or move down. But I think that we're in a very unusual situation at the moment where we do have a supply is playing a big role in the direction of long-term rates. And so I think that coupled with official tightenings, there could be some problems.
Also, there's been plenty of chatter this week about the government deposit guarantee, should it come off. We have talked about this before, but it's interesting when you make comparisons with the United States and some of their monoline insurers, specifically AmBack. If it had had a guarantee slapped on it, would things be any different to the problems it's now facing?
Well, I suppose the US government would have a bigger problem on its hands. Look, I think as far as AmBack goes, I mean, what we're seeing here is the crystallisation of all of those views that markets had on those monoline insurers way back when the GFC started. I mean, basically they were wrapping synthetic obligations or CDOs, residential mortgage-backed security, backed CDOs. Realistically, they're falling out of that investment grade category is really, I suppose, the death knell.
So just to clarify, when it's had its rating slashed by S&P, that mandates pretty much everyone to review. Yeah,
it has a knock-on effect. I mean, I suppose going into default is one thing, but also that shift from investment grade to sub-investment grade is very meaningful because obviously the credit upgrade that they provide to the issuers that they wrap lose that credit rating as well. So it is a significant development. Anybody holding AmBack stock also may be required due to a mandate to liquidate that.
So it's in a catch-22. How does it get itself back up to investment grade?
Look, I just can't see that happening. I mean, I think the rating agency. I think it's a double C rating with a developing outlook, which is of huge concern.
And S&P saying what almost 1,500 related US and UK cash flow and synthetic CDO transactions are exposed. Yeah, so the tendrils are really
That's right.
wide.
This is the real evidence of the global knock-on effect. I mean, the default of these reference entities in CDOs, given that there already have been a number of these, can make some of these very unstable and can actually mean that it starts to eat into capital of investors.
Now, is there any related cost of funding issues that flow from this? That is to say, do our banks with their offshore funding issues and the fact that they have that exposure and are having to go to market will be having to pay more as a result of something like this?
Well, look, that comes back. I mean, nervousness in global capital markets, credit markets in particular, obviously has an impact on all players. It comes back to, you mentioned the government guarantee. I mean, obviously that's playing an important part in terms of stabilising their access to funds.
But Stevens doesn't want that to last for much longer. This is the interesting gulf now.
Look, that's right. I think if you look at when they introduced that measure, things were very different to where they are now. And I suppose the trade-off back then was that yes, there are knock-on effects and there are problems that it can cause, but this is, saving the banking sector is very important. Now we're not in that situation. When you look at the implication or the knock-on effects, it's not worth having the guarantee given the problems it can create.
Well, that's the thing. Are we really out of the woods? Does AMBAC really tell us that?
Well, the interesting thing about it, look, AMBAC's just one of many. We've talked about in the past that we're actually going through this part of the cycle now where we are going to see these companies go into default. Now, a lot of that's already been built into markets, but the actual reality, the crystallisation is something that we're going to have to live through. And if you look at the rating agencies, they're talking about massive spikes in default rates over coming months.
How does it work to sort of counteract the federal government's own borrowing program, just to have this guarantee in place?
Yeah, well, look, it's really interesting. I mean, I think, from an investor's perspective, there's not a lot of incentive to buy government bonds when you can buy government-backed bank-issued bonds at a considerable discount.
Can we see the chart on that? Yeah, bring it up. Yeah. Keep going.
Okay. Yeah. So what we've got here, what's actually happening, and this is evidence of the cracks starting to emerge in the markets due to supply.
They're having to push the yields up.
Well, that's right, but what's happening also is that traditionally, I suppose, the trading books buy bonds, hold them on their books and hedge them with futures. And what we're seeing is a massive widening between the futures level and the underlying bonds. Now, that really is saying that supply is causing problems, and so a lot of the traders' books are full, and if the demand is not from end holders, given the task that's required to sell a lot of bonds, where are they all going to live? And so I suppose what they're actually doing is competing with the banks in terms of the investment dollar.
How then, briefly, finally, does the government itself continue to promote sticking with the guarantee? It seems to be working against its own policy objective.
That's right, and that's what needs to be unwound. I think the banks need to be able to issue on their own, but I guess the problem is it the time now to be doing that? I don't think it can be an abrupt change. There need to be minor changes. I mean, obviously smaller ADIs paying larger rates doesn't make sense. When you look back prior to the GFC, that the regulator was happy to regulate all entities.
Sure.
So there's some issues here.
There are plenty of cans of worms in that debate. Jim, we'll leave it for now. Appreciate it.
Thanks, Carl.
See you soon. Jim, sitting there from Fixed